So I think we have some guests on here. Um, a few. If you want to put in the chat where you're from, then we can see who we're talking to or where we're talking to. St. Louis. I'm a big St. Louis Cardinals fan, so I love St. Louis. And my wife would move to Whitefish, Montana if she could, I think. She loves that place. In Glacier National Park.
So you're a St. Louis Cardinals fan, huh?
I am, yeah.
I'm actually a Chicago Cubs fan, so we got a little bit of a rivalry there.
Oh, we do. Yeah, my uncle just taught me that I should love the Cardinals and dislike the Cubs. So
Yep.
dislike
That's
was a
what they
nice
told me
word.
too. Yep.
So, well, we'll get started here in a second. Um, so I'm out of the Indianapolis area. Taylor, you want to share where you're out of?
Yeah, so right now I'm currently in Austin, Texas, but I'm originally from Iowa, Humboldt, Iowa. So it's a small
Nice.
farm town that no one's really heard of before, but it's more central Iowa, kind of north of Des Moines.
Okay.
So,
Well, it is 3 o'clock, so I'm just going to go ahead and get started. So Um, today we're going to talk about DSCR lending. Up until about 4 or 5 years ago, I didn't know what that was, and I've been in real estate since 2002, and I still didn't know what that was. So um, we're gonna do a little bit of talking. If you guys are in the STR business, then you have heard this term before. Um, so um, my name is Jason Royer from the Indianapolis area, and do I work for Team Savvy and help clients, buy and sell properties here in the area. I'm also an owner um, of STR properties as well. So, and Taylor is my guest. And Taylor, if you want to introduce yourself?
yeah, I'm Taylor Kleve. I'm with Visio Lending. I've been in the mortgage lending business, off and on for over 20 years now. And I don't own any short-term rentals as of right now, but I have some rentals in the past. So kind of familiar with the investment market a little bit. But anyway, I've been with Visio for almost 11 years now. And back in 2015, we were actually one of the first ones to come up with a DSCR loan. There was only a handful of us doing it at the time, and now obviously there's endless options. So I always like to pride myself saying that we were one of the first companies that actually pioneered the DSCR loan.
That's really cool.
Yeah.
Um, I'm gonna skip this next session. This is just kind of our team, and so we are nationwide, and we've got placed people all over the place. So if you are on our daily property emails, you will probably see properties from all over the country. So, um, but we're going to go through some questions and stuff. So again, I didn't know what a DSCR loan, and I met Taylor about 4 years ago when I was kind of in a pinch with another lender, and he saved my deal. And since then, I've used him a couple other times. So he's done 3 loans for me personally, and he's done some loans for some of my clients too. And he does an awesome job and does a good job of explaining it. So we're just going to go through some questions because some people might not know what DSCR lending is, or they have some questions, and we will do a Q&A at the end of it. So we just got some basic questions we're going to go over, and just make sure that you guys get your questions answered at the end too. So Taylor, what exactly is a DSCR loan? and how does that differ from just the traditional type of lending?
Okay, sure. So the acronym DSCR stands for Debt Service Coverage Ratio. And what that really measures is it tells the lender how well the property is going to cash flow. So meaning that how it's different from a traditional loan is we're not going to use your personal income to qualify for the loan. So like we're not going to use your tax returns or W-2s, pay stubs, or anything like that. We're going to look at the potential income the property is going to produce. Rather, if it's looking at a lease and a long-term rental, using market rents or appraisal, or there's other tools out there for a short-term rental income that we can get into a little bit later. But anyway, we just really don't want the average monthly rent to exceed our mortgage payment. So that's the main difference on how we qualified for the income. There's also just a few underwriting guidelines that are a little bit different from traditional financing as well with DSCR loans. So like for an example, DSCR loans are mainly business purpose loans only designed for investors. So it's nice. It gives investors flexibility because we're not going to cut them off on how many properties they own or how many mortgages on their credit. Some of your traditional lenders will, stop financing investors because, like I said, their portfolio is too big or they just have too many mortgages on their credit and they become a higher risk. Well, we don't, obviously cut them off. And another example too is we don't, source receipts and down payment money on DSCR loans. So, example, you go to your traditional lender and you have your down payment money ready to go. Well, it has to be sitting in your bank account for a certain period of time. Well, we understand that investors need to move money around a lot. So we're not going to, limit them for how long it has to be sitting in the account. So basically, as long as that money's in your account right before we go to final underwriting, we're good to go. So those are just, some of the examples that how DSCR lending, differs from traditional lending.
Yeah, very good. And I know that I asked a lot of questions and you were able to answer those because that's always having been in the real estate industry, I know some of those things as in seasoning and all that stuff. So when I
Yep.
ask those questions, you just been able to walk me through it.
Mhm.
So um why are they so popular with short-term rental investors? And you kind of hit on this a little bit. You mentioned we're not even going to pull your tax returns, which is,
Right. Right.
I've been in real again, I'm going back to 2002. And so that just seems crazy to me that somebody's going to do a loan for me and they're not even going to pull my tax returns, which is awesome.
Yeah, no, it really is. And short-term rentals obviously became, pretty popular, since the pandemic, that industry has just it exploded. And why the DSCR loan is so popular in the short-term rental market is because, as you know, typically the rental income is higher on a short-term rental than is a long-term rental. So it gives the investor the ability to qualify for a higher end property because the rental income is there and the DSCR is going to allow for a higher loan amount. So it's going to, allow the investor to qualify for a bigger, better deal, as opposed to maybe they're doing like a long-term rental purchase or something like that.
And so you just have to qualify for your rent amount needs to be at or above your mortgage payment, or
Correct.
is that so? It just
Yes.
has to be like a 1-to-1 ratio.
Yeah, I mean, some lenders are different. Some do a 1-to-1, some are even maybe up to a 1.0. But for us, we are at a 1.0, just meaning that you just, you have to break even. Like, if your mortgage payment was $1,500 a month and the rent payment's $1,500 a month, then your DSCR ratio is 1.0. And that's what we look for.
Okay. Do you get do you get better terms if it's higher than that?
So with us, you do the higher the debt service. So like when you go from let's say a 1.0 to a 1.2, the loan is a little bit less risky because you're cash flowing better on the property. So we do give our borrowers a reduction in the interest rate. Typically, it's about an 80% or so, but we do give them a reduction in interest rate on a higher DSCR ratio.
we do have a question. Somebody's put, you're talking about the mortgage payment is principal, insurance, taxes, or principal, interest, taxes, and insurance. Is it you're counting the whole
Correct.
thing? Okay.
Yeah, yes, we're counting the whole thing. Absolutely. Yep. Principal and interest, tax and insurance, and if there's any monthly HOA dues, those are also calculated in the debt service as well. But as far as like, like on STRs, you have like cleaning fees or management fees or whatever you pay, like say to Verbo or Air, I'm sorry, Airbnb. We don't count those. We're basically just doing our monthly mortgage payment as it is.
Okay. Very good.
Mhm.
Um, well, we may have already kind of answered this question a little bit. How do you calculate it? But we're just going to go. I mean, so it's basically um, rents versus payment.
Yeah, I
Principal.
mean, really, what you're doing is you're just basically just taking whatever the market rent divided by our mortgage payment, whatever our mortgage payment is going to be. So, like simple math again. Let's say our mortgage, or let's say the rent's 1,500, our mortgage payment's $1,000. Your debt service is going to be a 1.5. So that's how we calculate it.
So how do you calculate um, or get that number, what you think it's going to rent for? Is that an appraised value, or can you do actuals if it was already an existing STR? Could you use actuals?
Yeah, so when we're talking about STRs, it is a little different how we calculate the debt service coverage ratio. But so, for instance, on short-term rentals, or STR for short, we if it's already an existing rental, and let's say a borrower wants to do a refinance, then yeah, we'll definitely look at the actuals. We'd like to see maybe up to a year, but it's not required to have actuals or have a rental history. But it does help our underwriting team, come up with the monthly market rate to be used, for the DSCR. Now, with new purchases. Every lender, is a little bit different on, what they use to determine the DSCR and short-term rentals. But our team uses the website AirDNA. I know you're familiar with this. Some may out there, some may not be familiar with it, but it's a really good website that you can go on and mess around with a little bit and just give, kind of a general idea of what that area, how it's doing, as far as producing rental income for STRs.
Okay. And what if I've never owned a property before?
So we do lend. So, for instance, again, every lender is different. So, with us, we do require at least a mortgage history if you want to buy your first STR. Now, this could be your primary residence.
Okay.
So, what we do is we look back, as long as you have at least a 12-month mortgage history, open or closed within the last 3 years, then you can go ahead and purchase your first STR with us. Now, let's say you don't own your primary, you don't quite have that mortgage experience. We'll go ahead and you can maybe look into a long-term rental because we do lend to first-time investors with no mortgage history. They don't own their primary residence. I know most lenders require someone to own a primary before they even lend to them on a long-term rental, but we won't. So that could be a good starting point for a new investor, maybe to get that mortgage history, and then they can come back and maybe get into the SDR market.
Okay. So Scott asked about loan to value 1-to-1 ratio, and maybe you can hit on that. We may be actually going to touch base on some of that, but
Sure.
yeah, if you want to just chime in there.
Yeah. So what about LTVs? So on a new purchase, we're right now the going LTV is 80%. And just 20% down payment is what we're looking for. If you're ever looking to do, let's say, just a rate term refinance on a property where you just want to just pay off an existing mortgage debt, we will allow up to 80% LTV if need be. Otherwise, let's say if you're looking to get some extra cash, you got a bunch of equity in a property, and you have maybe a small or no lien at all, and you want to do a cash out loan to help you, purchase your next STR, we'll do up to 75% of the appraised value for cash out. And again, our ratio on all these LTVs, it just needs to be a 1.0. So as long as our debt service is 1.0, then it will support, either 80% or 75% LTV.
Awesome.
Yep.
Um, well, we've already hit this. I think some people have, I guess you said some lenders will be different. So do you broker it out to other companies? To
No, we are a direct lender. We don't broker out to any other companies. We basically have our own money, and once we close the loan, we may sell them to an outside loan buyer, which is like another financial institution. Or mainly, what we do is we just pool them up, and then we sell them in the open bond market. So basically, we do a securitization, and then we go ahead and we just sell them on the open market to bond investors, but we'll still be in charge of the loan. We'll have like a management fee we also have a servicer that'll take care of that loan.
okay, perfect. So for you guys, it's 1-to-1 on this question anyway. For the
Yeah, so like
DSCR.
for minimum DSCR ratio, then yeah, it's for us, it's just 1.0. Now, if it's like 1.1, that means your cash flow a little bit higher, but for us, it's just 1.0. That's all you need.
Okay,
And like I said, most lenders are different with their minimum DSCR requirements.
perfect. So what kind of documentation do you need for a DSCR loan? I know we mentioned that you don't have to have your tax records, but I'm sure you have
Sure.
to submit something.
Yeah, absolutely. It's still pretty simple. I mean, we just basically have you fill out, your mortgage loan application, which you can do online. And then, other documentation needed will be a copy of your ID. In most cases, investors like to close in an entity such like LLC. So you'll definitely want, a copy of your LLC docs. Now, if it's a long-term rental and if it's lease, we'll need a copy of a lease. And then other than that, that's, it's pretty much it as far as, documentation goes. We also, do have a reserve requirement where we do want to verify your funds in the bank account, and that's done electronically. So, once someone starts the loan process with us, they'll have their own portal where they can, see the loan stage and kind of how things are progressing. And then there'll be a section in there where they verify their funds through their bank account. And then obviously you have your traditional appraisal for the loan as well. So, but other than that, I mean, we try to keep it as simple as possible.
So when you check the bank account, do you have to have some sort of reserves back?
Yes, you do. So on top of your, let's say it's a purchase loan, on top of your down payment money, we also want to see 6 months reserves, which would be our total monthly loan payment, including taxes and insurance. Now, that can be separate from your down payment money. That could be anything liquid because I know some investors, they'll have multiple bank accounts they use, or if you want to use like a retirement statement, like a 401k or anything like that's liquid, we'll take that as well when looking at reserves.
But if I had a line of credit that I wanted to use for those reserves, can I show you the line of credit or do I have to have it in my bank
You
account?
you can withdraw from the line of credit and you want to deposit in your bank account that you're going to use to verify your down payment money. So that's something that you want to do beforehand, before the loan process, and
And it
then
just
we'll
has
just
to
use
be
the
there
money.
for a
Yep.
day when you check it and
Yep. Yep,
it
absolutely.
doesn't
Yep, good. Yeah, because
convert.
we don't source with seasons of funds. So like I
So,
said, you can withdraw, a couple of days and throw it in your account, and use that for your down payment money. Because I've definitely had some clients do that in the past.
okay, let's see. Interest rates. So
Yeah,
the Fed I know this doesn't directly affect interest rates with the Fed, but I
sure.
know that they just dropped rates 0.25 today.
They
Um,
did. They lowered the federal funds rate by a quarter. I did see that. Yes.
you know, so how does it compare to typical traditional loans?
So I tell you, so a while back, I mean, it was always kind of a general rule of thumb that our interest rates are going to be maybe like a 1% higher than your traditional financing. Well, that's not the case so much anymore. Because, like I said, we've been doing this for almost over 11 years now, and so our space has grown so much, and so there's not only is there a lot more lenders doing what we're doing, there's also a lot more loan buyers out there in our securitization market, which is a good thing because we have a home to sell these loans. And when that happens, it helps us drive our cost of capital down. And so now our rates are getting, pretty close to traditional. Like just for an example, some of our floor rates right now with zero origination fee, you're looking at anywhere from 6.1 to 6.25% right now on a 30-year loan,
Wow.
which is pretty competitive. And this is not investment property. I mean, like I know primary homes, they usually have lower rates, but like for investment properties where rates like this, compared to a bank, it's very competitive right now.
Yeah, that's awesome. I'm sure that you've seen it change drastically over the
Oh
years.
yeah, yes, this I have big time.
Um, I know somebody had a question in this, but I think we're going to get to some of your questions here in a second. But
Okay.
common mistakes investors make when applying for a DSCR loan.
So a few come to mind. I would say one would be underestimating the rental income. This is more typically found, I guess I would say more like in new investors. You got to make sure that you really are looking at the market you're going to invest in, and really do some due diligence. Like, making sure that, you're working with maybe like a management company who's experienced with the short-term rentals. And so when you're looking at a property, you want to make sure that there's other properties like the one you're looking to buy, and just see what they're producing. So, work with, like I said, any type of management company can get some of this info off some of the STR platforms, but really know your income, because that can really blow up a mortgage loan. It's like, for example, like we start the process, and if somebody has pretty low, or I'm sorry, when they underestimate the income, saying, okay, well, this is going to generate 7,000 a month. I'm like, okay, great. And then, I'll try to gauge as much as I can, but, I'm not the investor. I'm not, in that market. But I try what I can. But then, let's say once the appraisal comes in, and everything's starting to tighten up a little bit. Well, let's say the market rent comes in under that 7,000, it could hurt your loan amount a little bit. Because like I said, the DSCR needs to be at the 1.0 to support that loan size. So that's kind of one mistake I see, is underestimating the rental income of the property. I would say another common mistake would be um, high utilization on credit cards. People are not quite watching their credit, because our rates, they're dictated based off your credit score. Obviously, the higher credit score, the lower rate you're going to get. So I know it's common practice, among investors to, use credit cards, let's say, to rehab a new property. So as you know, when you have high balances on your credit cards, your rate drops. And so when you apply for the mortgage loan, you could be at a lower FICO score, and your rate's going to be a lot higher than you anticipated. So, my advice there would be, try to keep your balances on your credit cards to at least 30% of the high limit or less. Also, like if you're going to use like, funds for rehab, get like an installment loan, like an unsecured loan from your bank. Like most people, if you have good credit, you can get those loans, those installment loans, and they report different on your credit. And so, that way your revolving debt, which is your credit cards, is not, it does have a very high utilization, and it keeps your, scores down.
Good to know. And so I will typically help clients here in the Indianapolis market try to figure out what rents will be. And
Yeah,
any of the other savvy agents will be able to help
sure.
any of you guys out there to give you an idea on what rents are going to be for a property. So you can lean on us for a little bit of that.
Yeah.
Priscilla, I know you have a question. I think it will be answered on this next slide, probably. Um, yeah, so
Okay.
we've answered a little bit of this, but I think Priscilla had a question about condo tells. So do you
Yeah.
guys, will you do something like that?
So our company, excuse me, our company will not lend on a condo tel. Now there might be a few out there that will. They're just, the condo tells. It's got a little bit of a gray area, because I mean, you have that commercial aspect where like there's like a, it's kind of like hotel characteristics, right? Like you have like a check-in desk. or it's just kind of part of a resort. And so it's just, it has that commercial component to it, where, our loans are just designed for properties that are, fully just residential use. So yeah, the DSCR loans that we do, unfortunately, condo tells just do not work. But other property types, where the flexibility comes into play here is, obviously we do the traditional, single families. We'll do multi-families up to 4 units, condos, and non-warrantable condos. And I can tell you that there's a lot of lenders out there that do not like to lend on non-warrantable condos, but we will. And the great thing about us is we treat non-warrantable condos just like a warrantable condo, meaning that we're not going to limit your loan amount to your LTV just because it's a non-warrantable condo. And I know some of our competitors out there do so.
Okay.
And then,
Um, I Yeah, what will you explain what a non-warrantable condo is?
sure. So a non-warrantable condo basically is a property that is not going to be insured by, let's say, Freddie or Fannie, Fannie Mae or Freddie Mac. So what makes it a non-warrantable condo? There's a variety of things, but just some of the ones that I know of, like for instance, if I think more than 50% or somewhere around that range are of the condos owned are non-owner occupied, it makes them non-warrantable. I know if, let's say, if a certain percentage of the association dues are behind per units, it also makes them non-warrantable condos. And there's other lists out there, but that's just some of the common ones I could think of right now that makes it a non-warrantable condo.
Okay. One more question on this. So you guys are pretty comfortable with like up to 4 units. Once it gets beyond that, you guys kind of back off, or is there maybe
Yeah,
room in there?
yeah, because anything over 4 units is considered commercial use,
Commercial.
and that's a different type of loan altogether. We actually used to have a loan program, kind of pre-pandemic, and then up till about beginning of 2021, before the inflation and all the rates just jumped up. But we would lend on 5 to 8 units of mixed use. So again, anything over 4 units is considered commercial use. So yeah, it's just a different loan altogether. And as of right now, we don't offer any commercial loans.
Okay. Just want to clarify that.
Yep.
Um, Typical down payment. I mean, do you think we've kind of touched base on this? Your typical 80% is what I hear,
Yep.
75% cash out. Um,
Yep.
is that pretty common? You pretty much stick to that, or are there
Yeah.
exceptions?
Yeah, I mean, with us, we pretty much stick to that. The max loan to value is 80%, and that's pretty common across the board with DSCR lenders. I know there's been some out there in the past that's gone, done to 85% loan to value. I know the rates are a little higher and they're a little more difficult to qualify for. And also in the past there have been some our competitors who have tried to go 85% LTV on cash outs. Well, some of those lenders are no longer around. So
Hmm.
those have, kind of dwindled down. But anyway, yeah, typically what you're going to find out in the DSCR world on the max LTV would be 80% on a purchase and rate term refinance.
Okay. I know Stretch, you had a question about where down payment can come from, and we did answer that a little bit ago, but it can come from basically anywhere. It doesn't have to be seasoned. He does put like a 401k loan. Is that something that can be done, Taylor?
So yeah, I mean, typically when if you can withdraw from a 401k, I'm not exactly sure if that's something that goes directly into your bank account. If it is, then yes. I know some other people have questions about self-directed IRA, which we do not allow. But and anything basically that is liquid that you're able to borrow from and deposit into your bank account, that's what we're looking for.
Okay.
Now, as far as I know, we touched on 401k. Now, as far as verifying reserves, like our 6 months reserves of our loan payments, then, we can look at 401k statements, to cover those because we're not asking you, to withdraw that for our down payment or anything. It just shows that you have liquidity.
So it could be. Okay. All right. That's good to know.
But
Um, let's see. So how can we get better terms or rates? I know that the rates are pretty competitive. So do you see it getting better for certain types of buyers, or if you do a different loan to value, or what are some ways that we can get better rates, I guess?
yeah, so down payment, the more you can put down, the lower the rate is. So usually it's 5% increments. So with us, we start at 20% down, and then if you can put 25% down and 30% down, then yes, the rate does gets a little bit lower. Also, property types help, with interest rates. So example, your regular single family home is going to, give you the lowest rate. And then when you look at, 2 to 4 units or condos, those rates are, usually about a 1/4% higher. Also, loan sizes play effect on the rate as well. So like for us, if your loan size typically around, the 200,000 range up until, I would say about like 1.4 million, somewhere around there. I mean, yeah, your rates could go the same. But then when you have those smaller loan amounts, like example, if you have a loan amount, like around 125 or even 100,000, the rates do get up a little bit on those. And then also the biggest factor really is your credit score. With us, if you have a 760 or above credit score, you're our best pricing. But really, our credit tiers are pretty competitive. I would say, if you have at least like a 720 or higher credit score, you're going to get, a pretty good competitive rate. When you get, kind of below that, they do get up a little bit. But yeah, those are just, I would say, some of the main factors that would help investors get better interest rates out there.
Do you have a credit limit or a credit rate that you will go down to? Like, what's your lowest that you go down to?
So every lender is different. For us, we will go down to a credit score of 680.
680.
Yep.
Okay,
Yep.
good to know. Here's a good question that people will ask. Can you do it in your LLCs? I think you already
Absolutely.
said something about it too, but
Yeah. So most of our investors do close in LLCs just basically because they want that liability protection. Now, there are some states out there because we do make business purpose loans only that they do make our borrowers close in entities such as LLCs. So yeah, it's definitely a good idea to to close an LLC or an S corp or whatever you have. But we also obviously lend to individuals because there are states that will let someone choose you can close in your individual name or an entity. Like I said, there's about maybe 5, 6 states out there right now that we lend in that you have to close in an entity only.
does it have to be an existing LLC? Like, so if I wanted to buy a house and I wanted to create an LLC specifically for that house, can it be a brand new LLC?
Absolutely, it can. Yep, you can
Okay.
create your own LLC. It does not have to be or doesn't have experience on it. So as long as we know the name of the LLC, we can go ahead and start the loan process. I have, many investors who do that. And then, we just need to get a copy of the LLC docs before final underwriting.
Okay.
Yeah.
Got one more, and then we're going to go into some Q&A. But what advice would you give to a first-time STR investor looking to use this type of loan?
So I would say one advice would be to know how your lender calculates the debt service coverage ratio, especially on STRs, because everyone does it a little different. I know we use the website AirDNA. Our underwriting team does a pretty good job, researching the area and looking for comps, like properties that are like the one you're going to buy, and look at what kind of income they're producing, and then they do a very good job coming up with a common sense monthly market rent to determine the DSCR. Now, I know there's other lenders out there that will use the market rent on the appraisals. And so you have to be careful because not a lot of your appraisers are going to do the short-term rents on an appraisal. Sometimes they'll do the long-term rents. And so, as you know, when you do the long-term rents, on a short-term rental, it could mess up the DSCR a little bit because short-term rental properties are usually higher in value, and the long-term rents are a little bit lower. So what happens is it can affect your DSCR, meaning that the rental income is not going to support a higher loan payment. So it might force someone to put down a larger down payment. So, like example, if they're looking to put 20% down, well, now all of a sudden your rent is lower in the DSCR, and now you may have to put 30% down. So yeah, I would definitely, when you do your research, definitely try to figure out, how your lender determines how they calculate the DSCR.
Do you help kind of discuss this with the appraiser that this is going to be used for a DSCR, just going to be used as an STR and they should use those type of numbers?
So we are not actually allowed to communicate with appraisers. So we have an appraisal management company called AMCs for short. They're like the intermediary. Like we have to, use them for our communication. So to answer your question, on short-term rentals, we determine our own income. So it's not a requirement for the appraisers to go out there and get the short-term rental data on appraisals. And I know if we did request that, I know some AMCs have to use different forms, and it's more expensive to the borrower to have short-term rental income on an appraisal. So for us, we just put it as a rental property, and most of the time, I think the appraisers do come back with the long-term rents, but for us, we don't look at that. We have our own method of determining the short-term rents, and obviously they're going to be a lot higher than what you'll see on the appraisal.
So as long as they come back with a value that you're fine with, you're
It-
buying a house for 400, the value comes in at 400 from the appraisal. If their rent numbers don't match it, but you guys feel confident in your rent numbers, you're
right.
okay.
Yep.
Okay.
Absolutely. Absolutely.
Very, very, very good to know. So now we're just gonna go to some Q&A. I know there's a couple of questions on here that I've kind of went through and tried to ask them as they came in. Um, Somebody had a question. Can you lend on a home in a Cobra zone in the Outer Banks, in the 4x4 area of Corolla, North Carolina? I am unfamiliar with what that Cobra zone is, so I don't know. Do you know anything about
Yeah, I'm
that?
I'm I'm not familiar with what that Cobra zone is either. It must be something, locally. But I do know that North Carolina is one of our top states as far as STRs goes. We do a lot of loans in both the Carolinas actually. So you know, I would basically say if there's a property out there that you're not sure that we can do, like, so for example, I work with mortgage brokers and also investors directly. And so I always encourage people just to email me the address. And that way I can kind of take a look at to see if I can see any red flags. And, I'm pretty good about, seeing if there might be an issue before we start the process. Now, if it goes a little bit beyond what I can see, then the next safe practice is we just go ahead and we submit a loan application, and I have underwriting do a review before we even check credit, before we order the appraisal. We want to make sure that we're not wasting anybody's time. So what we'll do is we'll just get a pre-underwriting review on that property only, just to make sure that we're comfortable lending on it.
Awesome. Yeah, it's good to do that work
Yeah.
up front for sure.
Yes,
Uh,
absolutely.
Scott asked about any evolving loan products. So like somebody's going to buy a house for rehab. Um, could you do a DSCR loan on that?
So if you want to buy a house to rehab, we don't have that type of program. Like we don't lend rehab funds. That's kind of more of a hard money loan. So we basically lend on properties that are rent ready. So, I always encourage people, like if they're looking to, buy and rehab a property, there's a lot of hard money lenders out there that will do like a bridge loan. where they'll lend up a certain amount to the purchase price plus give you extra funds to rehab the property. And then once that property is completed, again, it doesn't have to have a rental history, but once that property is completed, then you can come back to us to do a refinance, and we'll pay off that high interest short-term hard money loan and give you a lower 30-year fixed rate on your property. And you can also, if there's extra, if there's equity in the property, you can also, tap into that, get extra cash to help purchase your next project.
Nice. Uh, Deanna asked if just to clarify, you're looking at credit score, not debt to income ratio.
That is correct. Yep. We don't look at DTI. Again, that's why we do not require any tax returns. We don't require W-2s. We don't even do employment verifications or anything like that. We basically are more, asset based, meaning that we're going to look at the property itself, look at the income that the property is going to provide, and we're also obviously, going to look at your credit as well. So, I always tell people that, I mean, as long as your credit score is a 680 or above, the property is rent ready and good condition, and you can verify you have enough funds in the account for the down payment money, you're pretty much going to have a loan with us.
Yeah, that's awesome. One of seriously the easiest loans. I love these loans. They're
Yeah.
fantastic. Um,
Yep, that's why I've been with this company for, almost 11 years now. I used to, before I did investor loans, I used to do, traditional loans. I've worked for banks. I've worked for mortgage brokers, even back during the subprime days. And I can tell you that I really enjoy this type of lending the most because it's simple, it's dependable, and I just enjoy it a lot more.
uh, Franklin asked if you can lend outside of the U.S.
Unfortunately, we cannot. That would be something I would like to see, especially, like let's say like in the US territories, like Puerto Rico or something like that. But as of right now, no, we just went strictly in the US.
Um, One other question. This is going back to that the Cobra zones or CBRA. They're just trying to clarify it. It's just
Oh, okay.
uh, do you know that what they're talking about?
Let's see.
I don't know if you can see the chat
Yeah,
screen.
I can see it right here. The federal government doesn't want people to build in the COBRA zone, so they won't provide funds or help in the in the case of a flood. Interesting. Okay.
Well, that brings up,
Yeah.
I mean, if it's in a flood zone, will you loan on it if you have flood
So
interest?
I mean, yeah, we lend on properties in a flood, so you just have to obtain flood insurance.
Okay.
Is all. So yeah, I mean that's I would say to answer that question, I mean that's something I think we would definitely look at doing. I would just say that that would be maybe something like on a case by case basis. Again, that'd be something that we'd want to get the address of the property up front first and just do a little bit of research to make sure we're comfortable lending on it before we waste anybody's time.
Awesome.
So,
I think that is the last of the questions that I see. So I
okay.
appreciate all the people being on here. If you guys got any questions, you guys can reach out. Um, Taylor's information was in the first slide of this. Um, but if anybody had any questions, we can put you in touch with Taylor too. So
Yeah,
I appreciate
absolutely.
you coming on, Taylor, and answering questions. Like I said, I've used Taylor 3 times personally and with clients, and he's always done an awesome job for me. So um,
Yeah,
give him
I
chance.
appreciate it.
So
Thanks for having me.
so
Appreciate it.
all right, I appreciate it. Thanks, guys.